It was the pre-dawn of the modern age. Twitter didn't exist. There was neither iPhone nor iPad. The year? 2006, and it was the last time the Federal Reserve raised interest rates. So it's not embarrassing to ask, what exactly is a Fed rate hike? The Federal Reserve controls outright only one interest rate in the economy, the one banks use to lend to each other overnight, or the Fed funds rate. The prime rate is tied to the Fed funds rate, and many consumer loans and credit cards are tied to the prime rate. With a higher rate, the Fed tries to slow down the economy. With a lower rate, it tries to stimulate the economy. That's what the Fed did with successive cuts during the financial crisis of 2007. It slashed rates to zero, where they've been for nearly 7 years. Raising rates this time will be complicated. When they were lowered to zero and the economy was still in the doldrums, the Fed tried to stimulate growth by buying long-term bonds, pumping $4 trillion of cash into the banking system. With all that money sloshing around, banks don't need to borrow from each other in the Fed funds market. They have plenty of cash of their own. The Fed solution? Pay the banks not to lend this extra cash. The Fed will offer banks what's called interest on excess reserves, inducing them to keep their money on account at the Fed and not lend it out. Loans to private borrowers will have to be at a rate above what the Fed is paying banks not to lend. Even with this, the Fed is unsure it can hit the target. So it's now going to try to keep the funds rate in a range, aiming for the midpoint. If the Fed hikes, the new range is expected to be between 25 and 50 basis points, or around 37.5 basis points. And that will be the dawn of a new age. Few, if any, central banks have ever permanently left zero. The Fed is looking to be the first one.